today's lecture, we shall be solving a practical problem involving the calculation of profit or loss on revaluation as well as the depreciation treatment. So this problem involves, apart from other minor adjustments, one major adjustment, that is revaluation of assets and liabilities. Just go through the problem first. We are given equities and liabilities on the liability side, shareholders' funds having capital being divided into shares of 10 rupees each. Then you are given reserve and surplus. There is a note for the same. Current liabilities including trades payable. Then you have on the asset side tangible assets, building, plant, intangibles are not there. Non-current investment, there is only one investment into the shares of subsidiary company by holding company on 1st July. Till now we are clear that if it is 1st July in the current financial year, 3 months fall in the pre, 9 months fall in the post period. Then you have inventories, trade receivables, cash and cash equivalent. This is just the simple information that we are given. Additionally, we are provided with the general reserve and surplus of the subsidiary company and holding company as given above. Their bifurcation is given. So we are given a total reserve and surplus of holding company of 6 lakh, which is split as general reserve 5 lakh, surplus 1 lakh, and subsidiary companies of 5 lakh and 10 lakh of general reserve and surplus. Totals up to 15 lakh. So the bifurcation is given in the notes as we do in our balance sheet. Further, it says that subsidiary company had a balance of 3 lakh and 4 lakh in its general reserve and surplus on 1/4/2017. So this is the opening balance. We need this information. Goods costing 1 lakh were destroyed in an accident and 75,000 was recovered from insurance company, which implies that it is the abnormal loss of 25,000. Now, this abnormal loss must be adjusted in the subsidiary company's surplus. So, this abnormal loss will be first added back and then it will be deducted from the pre or post period. Since this loss has taken place in June, it implies that the shares are acquired on 1st July. So, this loss is falling in the pre-acquisition period. So, when we are considering subsidiary company's surplus, that is given in the balance sheet and then the bifurcation given here. So we can note down this information as a third working note here because this needs to be done. Second working note is also for this as well as first. So there are 3 working notes which are relevant for reserve and surplus. So we have noted the point here. Okay. Creditors of subsidiary company includes 20,000 for goods purchased from holding company on which it made a profit of 20% on sales. Half of the stock is still unsold. So this is a common debt and common stock. Common debts of 20,000 from creditors will be reduced directly from trade payable and trade receivables. It's a common debt, it will be eliminated. Coming to the next part, the stock, which is also common. So for common stock we need to make calculations for unrealized profit and then it is adjusted. So right now we are just understanding the treatment of these. So what we can do is we can put a mark here that unrealized profit must be subtracted here. Unrealized profit, or you can put a mark, it is coming from 4th point. So you can put 4th point here. So it will be subtracted from inventories also. So all the adjustments, additional information that we are reading, it should be marked here so that we do not miss anything. Then you get last adjustment. Plant of subsidiary company with a book value of 2 lakh on 1/4/2017 was revalued at 3 lakh at the time of acquiring control. That is, the date of acquisition of the shares is the date of revaluation. Shares are acquired on 1st July. So this revaluation will also be taking place on 1st July. Now when we work for the revaluation of assets, then it gives us 2 figures. Profit or loss on revaluation and depreciation. So this 5th adjustment must be considered here in plant because fifth adjustment will be marked here because the change in the value must be adjusted in the consolidated balance, and since it will give us profit or loss as well as change in depreciation, so it should be marked here also because we will be adjusting these when we are making a statement of profit. So what we find is that while making the consolidated balance sheet, these informations will be adjusted in the consolidated balance sheet and the notes, whereas this includes 4 adjustments which we need to evaluate. So let us start with the calculation part. Our working notes are same as we do, that is, we start with the control ratio. So our first working note is control ratio, that is the ratio in which the control of subsidiary company is held by holding company and minorities. Let us see. Capital of this company is 5 lakh divided into 10 rupees shares. So 50,000 shares of 10 rupees each. Investment is given. Holding company invested into 30,000 shares of subsidiary company. So out of 50,000 shares, if holding company has held 30,000 shares, it means for minorities 20,000 shares are left. Remember, total capital was 5 lakh divided into 10 rupees shares. So 50,000 shares in all were there. Holding company has bought 30,000 shares, so 20 will be left for minorities. So the ratio is 3:2, or you can say 3/5 belongs to holding company, 2/5 belongs to minorities. Second is pre and post acquisition period ratio. So for that matter, follow the basic procedure. Your current year starts on 1st April 2017, ends on 31st of March 2018, and in between the shares have been acquired on 1st July. So the period starting from 1/4/2017 ending on 1st July is the pre-acquisition period. So we can say pre-acquisition period is from 1st July 2017, 1st April 2017 and ends on 1st July 2017. 3 months. Post-acquisition period, as the name says, post-acquisition, that is after acquisition. So you acquired shares on 1st July. So after this, it comes here. So it is from 1st July 2017 to 31st of March 2018. That is 9 months. So the pre and post acquisition ratio is 3:9, 1:3 or 1/4 and 3/4, which means that the first quarter of the year belongs to pre-period and last 3 quarters are belonging to post-acquisition period. Next is that we are to make calculations for the adjustments. Now there are 2 adjustments which involve calculation. Number 1 is the common stock. We are given creditors of subsidiary company includes 20,000 for goods purchased. So the goods were purchased for 20,000 and half of the stock is still unsold. So half of this 20,000 is still unsold, which is common stock. So our first calculation for adjustments is common stock. Common stock is that part of the stock sold by one company to another which is still unsold. So it is half of the stock sold, that is 10,000. So unrealized profit. Unrealized profit is the profit on this common stock which hasn't yet been realized. So common stock into the ratio of profit to selling price. So stock was 10,000. Company makes a profit of 20% on sales. See the question. Profit of 20% on sales, so that means 20% of this, so 1/5, 2,000 rupees. Now holding company's share is 3/5, that we have already calculated. Control is 3/5, so 3/5 of this will be 1,200. So this is unrealized profit and holding company's share in this. Now, regarding the common stock, holding company's share in unrealized profits, it is subtracted here. So we can say minus 1200 in the reserve and surplus and minus 1200 in the inventory. So the point 4 that we have marked here, it implies minus 1200. So we noted down this. Next adjustment is for revaluation of plant. Okay. Now, in order to revalue the plant, we are to find out profit or loss and depreciation. So for that matter, make a timeline. So in this year, starting from 1/4/2017 to 31st of March 2018, plant has been revalued on the date of acquisition, that is on 1st July 2017, and new value is given to be 3 lakh. Now fill up all the relevant information, then only the calculation is possible. So look at the plant information. It says plant was having a book value of 2 lakh on 1/4/2017. So in the beginning of the year, book value is 2 lakh. At the end of the year, book value can be taken from the balance sheet 1,80,000. So on this date, book value is 1,80,000. Now if we are to calculate profit or loss on plant, it can be determined by comparing the new value with the book value on this date. So we need to determine book value on this date. But book value on this date can be determined only when we know the rate of depreciation and opening balance. Opening balance is known, rate of depreciation is not known. So see, book value in the beginning 2 lakh, book value at the end 1,80,000. It means the depreciation of the year is 2 lakh minus 1,80,000, that is 20,000. So rate of depreciation will be 20,000 upon 2 lakh, because you charged this much depreciation on this value. So depreciation upon opening balance into 100, 10% is the rate of depreciation. So book value on the date of revaluation will be, since from the opening date 3 months have passed, so book value on 1st July 2017 will be book value in the beginning minus depreciation for 3 months, because 3 months have already passed when you change the value. So opening value is 2 lakh minus depreciation on this 2 lakh at the rate of 10% for 3 months. That gives you 5,000, which implies 1,95,000 is the book value at the time of valuation of the asset. So if the value is 1,95,000 and you revalue it at 3 lakh as given in the question. So do we have a case of profit or loss? New value is more, it means there is a capital profit on revaluation, which is the difference, 3 lakh minus 1,95,000. So 1,05,000 is the new profit on the revaluation. When we get profit, we don't need to look at the nature. A profit will always be capital profit because it is an extraordinary transaction. But if it is a loss, then the loss is taken as capital in nature if the revaluation takes place on or before the date of acquisition of shares. And if the revaluation takes place after acquiring the control of the company, that is in this period, then we have the revenue loss. So herein we have the profit. So see, new value was 3 lakh, book value came out to be 1,95,000. So we have a capital profit. Now the second issue that we are to settle for the revaluation is the depreciation. Now again remember the logic. you had the value in the beginning 2 lakh, so you charged depreciation on this 2 lakh for 10% for the whole year. Now on 1st July you change the value to 3 lakh. It means from July onwards depreciation should be charged on 3 lakh and not on 2 lakh. So you need to charge more depreciation on extra 1 lakh that you are putting in the value. So more depreciation on this 1 lakh for how many months? Since the revaluation has taken place on 1st July, so from this date onwards we need to charge more depreciation, which implies for these 9 months from 1st July to 31st of March. For these 9 months extra depreciation. So additional depreciation to be charged is 3 lakh minus 2 lakh. You charged it on 2 lakh, but now the value is 3. So on extra amount you need to put more depreciation. So it will be 3 lakh minus 2 lakh into 10% for 9 months. It is fairly logical if you understand the procedure. We don't even need to remember the rules, the formula. Although formula has been given in the preceding lecture, preceding video, but you don't need to remember it if you follow the logic. So on this amount, depreciation is 7,500. So we have got two calculations here: capital profit on revaluation and additional depreciation to be charged. When value increases, depreciation is charged more. When value reduces, that is there is a loss, then depreciation is to be added back. For this formula, again remember, understand it here. It was having a value of 2 lakh in the beginning, so you charged. You mean subsidiary company charged depreciation on 2 lakh for the whole year. But on 1st July you want to bring in 3 lakh as the value. It means you want to bring in 1 lakh more in the value. So on this additional 1 lakh you need to charge more depreciation. So from this date onwards, on extra 1 lakh depreciation is to be charged more. So on 1 lakh depreciation at the prescribed rate of 10% for 9 months starting from the date you bring in the change. So additional depreciation has been calculated. Now we have already put in a mark for these two calculations in our question. See here, we recorded it that this fifth adjustment, so herein we can say that increase in the value must be added and depreciation must be reduced. Okay. Similarly, this fifth point here means 1,05,000 to be added and 7,500 to be reduced. So you can put in these amounts here, or you can just remember with the points here. Okay. So this we can understand. Now, so a statement of analysis of the capital and all type of profits shall be prepared. Capital and all profits and reserves of subsidiary company is to be prepared. So let us make a format of the same. It shall be having 5 columns. Three columns are for the amounts, which are capital and revenue amounts, and first column is for the serial number and then the details. So this is the format. Then you have here capital plus capital profits, revenue reserve, revenue surplus. Now in this we are to record all the amounts of subsidiary company which are not directly added, which goes through the analysis part. So from the balance sheet of the subsidiary company, we know that the amounts which will be adjusted here are share capital, reserve and surplus. For reserve and surplus, we have certain adjustments here. 1, 2, 3 and 5. 1 and 2 are for the balances of reserve and surplus separately and opening and closing balance. Third adjustment was for the abnormal loss, and fifth is for the capital profit on the revaluation. So taking up this, first thing is share capital of subsidiary company, which is not added directly, so it is adjusted here, 5 lakh. Second is general reserve. We are given in the notes that general reserve of subsidiary company is 5 lakh. The closing balance 5 lakh. Out of this 5 lakh, we have an opening balance as given to be 3 lakh. So 3 lakh directly belongs to capital part. We are left with current year amount 2 lakh rupees. So current year is split into pre and post in the ratio of 1:3. First quarter is in the pre-acquisition period. So general reserve for pre-acquisition period 2 lakh into 1/4, that is 50,000 coming here. General reserve for post-acquisition period 2 lakh into 3/4, 1,50,000 here. Surplus. Surplus has a closing balance of 10 lakh given to us. If we deduct the opening balance, that is 4 lakh, we are left with the current year amount of 6 lakh. So this 4 lakh is directly taken here. Now 6 lakh is the current year amount, but it is subject to one adjustment, which is of abnormal loss. In case of abnormal losses, they are first of all added back, because we are to remove the effect of abnormal loss. So abnormal loss of 25,000 will be added back to calculate normal profit of the year, which will be split into pre and post, and the actual loss is subtracted from the relevant time period to which it belongs. Since this loss has taken place in the month of June, so it falls in pre-acquisition period. So 25,000 will be subtracted from here. Now this will be surplus for pre-acquisition period 6,25,000 into 1/4, that is 1,56,250, and for the post period, that is 6,25,000 into 3/4, it is 4,68,750. Further, we had one more adjustment of revaluation. So we got capital profit on revaluation of plant 1,05,000. Then we had depreciation to be charged, additional depreciation to be charged, as we calculated this amount of depreciation from the date of revaluation up to the year end, which means this depreciation is for the last 9 months. Last 9 months belong to post period. So this will be subtracted here. So we have recorded everything in this statement. Just total up the amounts: 14,86,250, 1,50,000 and 4,61,250. Now consider this, that the amount belongs to both holding company and minorities. So split it into holding company and minorities in their control ratio, which is 3/5 and 2/5. So this amount is divided in 3:2 ratio for these two persons. 8,91,750 and 5,94,500. This is in 3:2 ratio, 90,000, 60,000, and this gives us 2,76,750 and 1,84,500. So that completes our statement. So what we have done through this statement is that all the amounts of your capital and all relevant profits, reserves, etc. have now been combined into 6 figures. 3 figures belong to minorities. So the share of minorities will be joined together to calculate minorities' interest. Holding company's share in the capital and capital profits will be adjusted against the cost of control. So you will calculate cost of control or goodwill by comparing this amount with the cost of investment. Now these two amounts are the revenue amounts, revenue reserve, revenue surplus. So it goes in the consolidated balance sheet. So the treatment of the 6 figures that we have calculated from this must be very clear. This is minorities' interest. So here goes 3 amounts. They go into minorities' interest. This goes in consolidated balance sheet and this goes in the calculation of cost of control. So it is compared against cost of investment. So after calculation of these amounts, we will be calculating next working note, that is minorities' interest. So minorities' interest will be calculated as a part of next working note. Minorities' interest. It is the sum total of the share of minorities in all the profits and reserves, etc. So share of minorities in capital and capital profits, etc. of subsidiary company, 5,94,500. Share of minorities in revenue reserve, 60,000. Share of minorities in surplus, 1,84,500. So that gives us 8,39,000 as the minorities interest. Next is calculation of goodwill or cost of control. So goodwill, cost of control or capital reserve will be calculated here by comparing cost of investment by holding company into the shares of subsidiary company, that is 10 lakh. So this is to be compared with share of holding company into the capital and capital profits of subsidiary company. That is the worth that you have got from the company, and the amount that we calculated was 8,91,750. Consider this statement. Holding company's share in the capital and all the profits, 8,91,750. So this will be adjusted here. So if you compare the two, you have a case of goodwill. Goodwill on consolidation is 1,08,250. Okay, so this is your goodwill, but this is not the final amount appearing in the consolidated balance sheet. This must be adjusted against any kind of capital reserve or goodwill given in the question. So if in your question you are given any other goodwill of holding or subsidiary company, it will be added here. If you are given capital reserve of subsidiary company, it must be reduced from here and final amount will appear. So that completes all the working notes. Now we are to prepare consolidated balance sheet of holding company and its subsidiary company on the given date, that is 31st of March 2018. So make a format for the same. So this step is fairly easy because we are just to prepare the format. Serial number, details or particulars, note number, and the amount in Indian rupees. So that will be the balance sheet. Your first component is equity and liabilities. In this, we are to record number 1, shareholders funds, which includes share capital and reserve and surplus. Minorities interest comes just after this, so it will be recorded here. Thirdly, we have current liabilities given in the problem. So current liabilities, this format can be had from the problem itself. So this includes trade payable, that will give you the total here. Second component is assets. Now assets include number 1, non-current assets. Non-current assets includes first subcomponent fixed assets, which are again tangibles. Intangibles like goodwill, which we have calculated. It may include copyright, patents, etc. if you are given any. So composite amount will be written here. Then you have non-current investments. We could easily forget it also, because we know that all the investments belong to the common pool. That is, holding company has made investment into subsidiary company. No other investment is there. Then you have the current assets, which includes inventories, trade receivables, and cash equivalents. And then the amounts will be totaled here. So that completes the format. Now coming to the numbering part, numbering of the working notes. So see here, you have shareholders capital number 1, reserve and surplus number 2, minorities interest number 3. Now the amounts which are to be consolidated together, they can all be given only one working note, 444. Intangibles will be written separately. So next is preparing notes to the balance sheet. So notes to the consolidated balance sheet, number 1 is share capital. First note was share capital. So we know that the company is having share capital of 20 lakhs divided into shares of 10 rupees each. So it is authorized, subscribed, issued, called and paid share capital of 2 lakh shares of 10 rupees each, 20 lakhs. So the total amount is written here in this balance sheet, 20 lakhs. Second is reserve and surplus. Second note, reserve and surplus. Now in the reserve and surplus, we are given holding company is having general reserve and surplus. So general reserve of holding company is 5 lakh as given, plus they got share in the revenue reserve of subsidiary company 90,000. You can check the statement of analysis. So that gives you 590. Then the surplus. Holding company has a surplus of 1 lakh. Plus they got share in the surplus of subsidiary company 2,76,750. Apart from that, we had some adjustments also. So the adjustments which were marked here, you know that 1200 is to be subtracted for unrealized profit. So minus share of holding company in unrealized profit on common stock, 1200 separated. So that gives you 3,75,550. 9,65,550 is your total reserve and surplus via second note to the balance sheet. So put it into the balance sheet. 9,65,550. Third is minorities interest. We have already calculated. So minorities interest is 8,39,000. You can write here working note number 5. So just put it here, 8,39,000. Now all these are to be clubbed together. So just have a look at the question. How many columns do we need in this statement? Trade payable, building, plant, investment, and all these three. So 1, 2, 3, 4, 5, 6 and 7 items are to be clubbed together. So consolidated balances statement, our fourth working note, it will be having 7 plus 1, 8 columns. So just make this format for this statement. One, 2, 3, 4, 5, 6, 7 and 8. So 8 columns have been made here for the consolidation of the balances. Right. So this is for the details. Now write up the account names. Trade payable. Then you have building, plant. Then you have non-current investments, inventories, bills, trade receivables. Then you have cash plus cash equivalents. So write up the amounts from the balance sheet. So for holding company, trade payable 4 lakh, for subsidiary company 2 lakh, building 4 lakh, 3,20,000, 6 lakh, 1,80,000, 10 lakh, nothing, 5 lakh, 4,50,000, 3 lakh, 10 lakh, 2 lakh, 2,50,000. So the total is 6 lakh, 720, 780, 10 lakhs, 9,50,000, 13 lakh, 4,50,000. Now adjust all the additional information for which we have already put a mark here. See, trade payable 20,000 common amount. So deduct less common amounts, common debts. So you have already put the mark in the question. So just pick up amounts from there. Trade payable and trade receivables 20,000. Then you had unrealized profit from inventories 1,200. This 10 lakh was also common. Then you had capital profit on revaluation of plant 1,05,000. Then you had depreciation to be deducted 7,500. So that records all the adjustments. So we have the balance of 580 here, 7,20,000 here, and here in the balances 8,77,500, nothing here, 9,48,800 here, 12,80,000 here, 4,50,000 here. So that means the total. Now when we look at the amounts, we know that building and plant must be combined together. So we can write here tangible assets. That means 15,97,500. You can write it separately also. So just write all the totals. Trade payable 5,80,000. Tangibles 15 lakh, 97,500. Intangible we have worked out separately. Inventories 9,48,800. Trade receivables 12,80,000. Then you have 4,50,000. Now goodwill, intangibles, which is through the last working note. So goodwill, we have calculated the amount of goodwill, so we just need to record it here. 1,08,250, and we can write working note number 6. This is what we have done. So 1,08,250 here. Total up the liabilities and assets. So that completes your balance sheet. So see, the basic thing is that we have to remember is, since so many adjustments are involved, we don't forget anything while making the balance sheet. So just make a mark while reading the question. So when you are reading the question and additional information, put a mark at all the relevant places. If something is to be recorded in the profits in this statement, record it here. So these two are not to be added, rest will go for direct addition. So make the working notes after this. We calculated control ratio, pre-post period ratio, then calculation of common stock, and the two issues of revaluation, that is profit or loss and additional depreciation. Then we moved on to the preparation of the statement of analysis of capital and profits, etc. So that gave us 6 figures, and we need to know where to compile them. Minorities here is combined together to get minorities interest. These two go in the balance sheet. This is for cost of control. This is all common for all the problems. Whether you have 1 adjustment, 2 adjustment, 10 adjustments, once we prepare this statement, everything becomes simple because everything falls at its place and we know where to take these figures. We have just to remember that. So after this, we calculated the minorities interest, goodwill, then we prepared the balance sheet. In this, we just gave the notes for all the relevant amounts. So that shows how the revaluation of the assets is adjusted in the consolidation. Now next time we'll be taking up the next adjustment, that is bonus issue. Thank you.